Howdy, everybody. Welcome to Liberty Call. Hope you're having a fantastical day out there in the interwebs. It is a pretty nice day here in Colorado. Not nearly as hot as it was over the weekend. Woo! Sweaty and gross and nasty. Plus, I was doing like chores around the house, redoing a wall in the dining room and getting all sweaty and dusty. So anyways, hope you had a good weekend. Astros did not. They sucked over. They lost Saturday and Sunday to the Rays and only managed to win the Friday night game. And they're just no offense. I mean, pitching was great. I mean, Arrighetti yesterday looked fantastic. If you're not, watch Astros baseball. I mean, just I don't know. It's like one day the bats are there and the pitching is terrible, and then other days the pitching's great and the bats go cold. So, anyways, you didn't come here for baseball news. You came here to find out what's going on in the economy and the markets, right? Ugly day. Whew, nasty. All right, but before we get to that, if you could, do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All right, like I said, markets were ugly like a redheaded stepchild. I mean, Dow Jones was down 2.6%, 1,033 points, closed at 38,703. S&P 500 was down 2.93%, 156 points, closed at 5190. NASDAQ down 3.38%, 567 points, closed at 16,208. The VIX is up 58.23% today. It's at 3716 right now. It's over 30, folks. The red light has come on, so be careful out there. Canada down 2.18, Brazil down 0.59, and Mexico down 0.9. Headed over to Europe, Germany was down 1.95, the UK down 2.04, France down 1.42, Netherlands down 2.1, Spain down 2.34, Italy down 2.27, Switzerland down 2.63, Portugal down 1.87. Russian exchanges, MOEX down 2.35, RTSI down 1.49, and the overnight's the big one. I saw this last night before I went to bed. The Nikkei in Japan was down 13.47%. Australia down 3.7, New Zealand down 2.35. In China, the Shanghai was down 1.54, Shenzhen Component down 1.85, China A50 down 0.59, DJ Shanghai down 1.46, same with the Hang Seng, and the Taiwan weighted when it closed on the second last, it was down 4.43. So like I said, ugly, ugly day. It's not surprising. I've been saying this for a while. The economy's been kind of rickety and just kind of hanging on by threads. And at some point, there's a say, I think Warren Buffett said it. It was slowly until it was quickly or until it was sudden or something like that. So, I mean, it's, things will hold together for so long. And then eventually it's kind of like, if you've ever seen like those big piles at like concrete factories where they have the conveyor belts and the sand goes up and up and up, and it just continues to make this big pile of sand. Well, eventually comes to a point where the weight of the sand up at the top will something will collapse and it'll just fall. It's the same thing. We don't know what the trigger is going to be. Could it be a bad economic report? Could it be a business closing down that kind of caught people off guard? Could it be the idiots in government? Could it be a war? I don't know. So we've got a lot of those things, a lot of those irons in the fire right now. So, all right, let's get to the weekly economic update. Stocks fell broadly last week as investors looked past upbeat Fed comments and focused on disappointing corporate reports and weaker than expected economic data. That's what I'd pay attention to, corporate reports and economic data, rather than what the Fed's blah, 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 just filling our smoke up our butts. The Dow Jones Industrial Average lost 2.2%, S&P 500 fell 2.06%, NASDAQ dropped 3.35%, and overseas markets gained 0.19%. Volatile week of trading. Stocks were under pressure early in the week as investors appeared to focus on the Fed's meeting, which ended on Wednesday. It was a big week for Q2 corporate reports, with 5 of the 10 largest names in the S&P 500 by market cap reporting numbers. But attention was mainly on the Fed's meeting. Stocks rallied on Wednesday when Fed Chair Powell indicated a September interest rate cut was on the table. That's in quotes. But selling picked up on Thursday as investors' attention quickly shifted to disappointing corporate reports and weaker economic data. Friday morning's disappointing June jobs report raised even more questions about the economy's strength. The NASDAQ ended the week in correction territory, down more than 10% from its recent all-time high. Economic concerns. Fresh economic data suggested weakening manufacturing, construction jobs, and employment outlooks. On Friday, the Labor Department's July Jobs report showed a sharper than expected job growth slowdown and an unemployment uptick to 4.3%, the highest rate in 2.5 years. And I don't think anybody expected the uptick in unemployment. Now, if you look at the U6 unemployment, it is really, really high, and which is the unemployment figures that we used up until I think 92 or 93. Peter Schiff was talking about it on this Friday podcast, and so it is kind of hard to compare unemployment numbers from say the 80s or the 70s to today because they use different metrics. For example, one that is a big one is that after a year of being unemployed, if you're just kind of disgruntled, you fall out of the U3 or the regular unemployment figures versus the U6, where you stay in those numbers. You continue to show as an unemployed worker. So, all right, back into it. At Wednesday's Fed press conference, investors welcomed Powell's unusually candid and upbeat comments. However, as the week progressed, investors started questioning whether the Fed was misreading the economy and moving too slowly in adjusting interest rates. Well, like I said before, I don't think that the Fed was going to do anything until something, some sort of a black swan appeared, some sort of a catastrophe where they actually had a reason. Because just lowering rates for the sake of lowering rates, especially when the people in Washington and the economic journalists, tell us, everything is fine, everything's wonderful. Guys like Jim Cramer last week were saying, oh, everything's good, nothing's wrong. Yeah. If Cramer says something's good, something's bad's going to happen. If he says something bad's going to happen, odds are something good's going to happen. So. All right. Economic data this week, Monday, the ISM Services Index and Fed official Mary Daly is speaking. Tuesday, we have the International Trade in Goods and Services Treasury buyback announcement. Wednesday, we have consumer credit and the EIA petroleum status report. Thursday's jobless claims and the Fed's balance sheet. Pretty light week. Companies reporting earnings this week, also fairly light. Tuesday, we have Amgen, Caterpillar, Uber Technologies, and Airbnb. Wednesday is Walt Disney. Thursday is Eli Lilly and Gilead Sciences. All right, so that is all the financial news for the weekly update. I hope you feel smarter. I know I do. See, my head's a little bigger. All right, let's get into the market recap for today. U.S. stocks in sell-off mode as economic concerns mount. Oh no. U.S. stocks experienced a significant sell-off on Monday as concerns over an economic slowdown heavily impacted high-flying technology stocks. The sell-off continued from the previous week, driven by fears that the Federal Reserve's prolonged high interest rates might be pushing the economy towards a hard landing. Well, maybe you shouldn't have printed all that money 4 summers ago if you didn't want to deal with this now. See, no one ever wants to deal with the consequences of their actions. I mean, that's just typical. I mean, you look at the government, you look at the people on the left, they always want to, like getting out of paying their student loans or, other things that they don't want to deal with. They just, let's just have the government take care of it. The anxiety intensified on Friday following a disappointing non-farm payrolls report for July, which indicated a substantial cooling in the labor market. Despite boosting hopes for imminent interest rate cuts by the Fed, the data diminished investor appetite for riskier assets. Goldman Sachs noted, we now expect faster cuts because the funds rate looks more clearly inappropriately high. However, Monday's economic data painted a more nuanced picture. The July ISM Services PMI exceeded economists' estimates, and the prices paid component, a measure of inflation, also came in higher than expected. This suggests that a recession may not be immediately imminent. Well, tell that to the traders on Wall Street. Federal Reserve officials are under scrutiny this week as markets anticipate aggressive rate cuts. Chicago Fed President Austin Goolsbee, a major moron, hinted that the current interest rates might be overly restrictive given signs of economic weakness. San Francisco Fed President Mary Daly was also expected to speak on Monday. Markets are pricing in a 78% chance of 50 basis points in rate cuts in September, though some, like Morgan Stanley, argue it might be premature for such a significant reduction. Apple led the tech rout with its stock falling over 6% after Warren Buffett's Berkshire Hathaway sold nearly half of its stake in the company. NVIDIA shares dropped 7% following reports of delays in its new AI chips due to design flaws. Lucid Group and BioNTech also saw declines, the latter due to underwhelming second quarter earnings from dwindling COVID-19 vaccine sales. Looking ahead, high-profile earnings are due from industrial leader Caterpillar and ride-sharing giant Uber on Tuesday. Supermicro, which has surged in value due to AI hype, will also report on Tuesday, followed by media titans Walt Disney and Warner Brothers on Wednesday. So Anyways, that's some good stuff, don't you think? And it's just a little poetic. I mean, how the Fed is obsessed with inflation, and which has now led them to where they're kind of painted into a corner regarding rate cuts. So I mean, it's like they're just chasing their tail, and every problem that they try to fix, they just create another problem in its wake. And it would be funny if it wasn't so tragic for the rest of the world. So unfortunately, I can't help everybody out there. So. All right, next up, I got some data here. July ISM Non-Manufacturing Index. This comes to us via First Trust and Nate Guernsey, economic analyst. All right, the ISM Services Index returned to expansionary territory in July following a period of volatility for the U.S. services sector. The positive news includes increases in nearly every major activity measure, all above the 50 mark, indicating expansion. An exception is the Supplier Deliveries Index, which fell to 47.6 from 52.2. A below 50 reading here is positive, reflecting shorter delivery times. However, the sector has contracted in 2 of the past 4 months. The new orders index is at its lowest point in 2020 since 2023, and the employment index has been in contraction for 6 out of the last 8 months. Inflation remains a pressing issue, with prices paid index rising to 57 in July, and 11 of the 18 major services industries reporting higher prices. This is significant as the services sector has been a major contributor to persistent inflation over the past 2 years. It is expected that both inflation and sector growth will decelerate due to lagged effects of the decline of M2 money supply from early 22 to late 23. Additionally, car and light truck sales were at a 15.8 million annual rate in July, a 4.2% increase from June, but 0.8% lower than a year ago. So it looks like the Fed's master plan is working for now. It's almost, it's just, I don't know. I mean, I guess if you could just print money out, if printing money solved all of our problems, I guess we would be out of every issue. But unfortunately, that's their go-to thing, and all it does is create more issues. All right, let's get that off the screen and get over here to Mr. Brian Westbury's weekly Monday article. The lags are over for tighter money. So let's see what Brian had to say. All right, as Milton Friedman famously taught, monetary policy operates with long and variable lags. Recent reports suggest these lags from the 2022 to 2023 tightening are finally ending, with both inflation and economic growth slowing down. In June, consumer prices fell by 0.1%, the largest drop since the early days of COVID, primarily due to lower energy prices. Core consumer prices only increased 0.1%, the smallest rise in over 3 years, while the CPI was still up 3% year over year in June. This rate is expected to slow further in the coming months, especially with falling oil prices. But with the conflicts over in the Middle East, who knows? That could be a quick reversal. The economy showing more signs of softness. The housing sector is sluggish, with new private housing construction values down for 3 consecutive months. Existing home sales are near their lowest since 2010. New home sales are below pre-COVID levels. The ISM Manufacturing Index dropped to 46.8 in July, indicating contraction, with the production component falling to 45.9, the lowest since the COVID lockdown. July's employment report showed a marked deceleration, with non-farm payrolls increasing by only 114,000, the lowest since January of 21, and revisions cutting prior month's gains by 29,000. Excluding certain sectors, core payrolls rose just 17,000 in July, the smallest gain this year. The unemployment rate also rose to 4.3%, up 0.4 percentage points over the last 3 months, often a recession indicator. M2 money supply growth has been modest at 2.4% annualized since October, much slower than the pre-COVID average of 6.1%. With decelerating inflation and growth and a slow M2 rebound, there's a strong case that the Fed's policy is tight. The Fed now has room to ease monetary policy, potentially through rate cuts. However, focusing solely on rate cuts isn't sufficient. The Fed needs to monitor the money supply to ensure genuine easing. Missteps could lead to stagflation, as experienced in the 1970s. So, yeah, the Federal Reserve running things, it's kind of like, they're driving like a big truck, and, every time they push on the brakes, they're squeaking, and they just can't figure out why. Well, why are my brakes squeaking? It's like, well, maybe if you took your tires off and looked to see if you had any brake pads left, you could figure it out. But again, these morons just keep their heads in the sand and just never solve anything. So, all right, we got one more article here on some new IRS rules. This comes via Zero Hedge. New IRS rules create headaches for post-2019 IRA inheritors. So, all right. The IRS has finally issued a long-awaited rule for mandatory distributions from inherited 401ks, IRAs, and other retirement plans. The new rules apply to those who inherited such accounts in 2020 or later and have introduced a highly complex procedure for beneficiaries and their financial planners. Awesome. Thanks, guys. I appreciate that. The new rules concern inherited IRAs from individuals who are already required to take RMDs before their death, required minimum distributions. As of now, this requirement starts at age 73, but it was at age 72 in 2020 and will rise to 75 in 2033. Well, we've got a few years before that. Have to worry about that. Spouse beneficiaries are exempt from these new requirements and can continue to treat inherited assets as their own. Eligible designated beneficiaries, such as those who are disabled or minor children, also enjoy certain flexibilities. However, other beneficiaries, such as adult children of a deceased IRA owner, mandatory distributions must be taken over a 10-year period according to an IRS life expectancy table, not a fixed annual amount. Miscalculating or neglecting these distributions can result in a 25% penalty on the amount that should have been withdrawn. How very nice of the IRS to penalize you for money that's not theirs. These changes stem from the Secure Act of December 2019, which eliminated the stretch IRA that allows beneficiaries to spread distributions over their lifetime. The new law requires non-spouse beneficiaries to empty the account by the end of the 10th year after the original owner's death. Initially, it was believed beneficiaries could choose or how much to withdraw each year, as long as the account was empty by year 10. However, in 2022, the IRS mandated annual withdrawals, leading to confusion and frustration. The new rules apply to those who inherited IRAs in 2020 or later. The IRS will not penalize beneficiaries who missed required distributions in 21 through 2024, but starting in 2025, RMDs must be taken. So just leave it to the IRS to take the tax code and make it even more complicated. So thank you. Thanks, guys. All right. That was all the news I had to share for today. So I hope you're, especially with everything going on in the world, I hope you're, have a little cheer, because the markets are probably going to be worse or ugly for a while. If it's anything like the last time, it took from peak to trough about 18 months. So if this is the beginning, sometime end of next year would potentially be the bottom. Again, it kind of depends on how fast that occurs. So I highly doubt we'll have a recession. I'm putting that in quotes, like we did back in March, April of 2020, where it went and just, jumped back up. Again, I have to imagine those in Wall Street got telegraphed that there was going to be a big pile of cash dumped into the economy from Congress that, the little people like you and me just don't get. So I was caught a little off guard. I was expecting that, the economy was going to slide for, 6 months or a while at least, and not reverse, in less than 30 days. So anyways, all right. Well, if anyone needs anything from me, please go to there it is, DSAFinancialGroup.com. All my contact information is there if you need to book a meeting to get your financial crap together, or just make sure your investments don't go from a 401k to a 201k. Give me a buzz. I'd be happy to help. All right. Well, like I said, that's everything I had for today. Hope everyone has a wonderful evening. Watch some baseball. I know I will. And I'll talk to you all again next time. Adios.